Now, Sarah, everyone's going to be right eventually, but they set it at 3, nothing broke, 4, 5, and now we're talking 6.
So here's something that I find interesting about that. If you think about whether or not we were all underpricing what the Fed was going to do, which arguably if 3 was the limit, we were underpricing that 6 months ago. I wonder now if 6% is starting to overprice a little bit, although, maybe we could get up to touch there for a period of time. I think really the biggest thing that stood out to me from what he was talking about yesterday was you're using backward-looking data for forward-looking action, which is raising rates. And I think that's the most difficult thing. I mean, I know that you guys earlier this morning were talking about the whole long and variable lag issue and whether or not that has any meaning and whether or not that's an older statistic. But I do think that there are parts of the economy for which those changes don't happen so quickly. And very often, like a lot of contracts are priced yearly. A lot of things happen on a not quarter to quarter basis. And Wall Street is so used to focusing on the quarters that we lose sight of the fact that, wage negotiations don't happen every time the Fed changes rates. It happens once a year or once every couple of years, depending on the industry. So I think that there is an argument to be made that some of the effects are not being seen yet. But I also think you're starting to see some issues in the lower credit markets. You're seeing subprime auto, you're seeing some of the subprime credit card start to see more charge-offs. And I think that's a sign that things are getting tougher, especially on that lower end.